Hi there. In this episode of Member of the Public, we're going to talk about something you often hear about, but perhaps also would like to know more about. The economic concept of GDP. See you at the other side. Basically, GDP or gross domestic product allows you to track the creation of economic value in a certain geographical space and over a certain period in time. Usually that space is a country and usually that period is a year, but not necessarily. You can also calculate GDP for, say, a certain province or for a quarter year. However, the generally accepted view is that it is private enterprise that creates this economic value. So explaining GDP best starts with having a look at what's going on at company level. How do companies create value? Well, the answer is simple. They create value by producing and selling products. These products can be anything, of course, but we can split them up in two major groups. Goods are products you can shelve in a warehouse, like canned food, smartphones, forklifts, or even fighter jets. Services are products that are impossible to stock, like a haircut, plumbing repair, an advertising campaign, or legal advice. Now let's consider a single company. We'll call it Company A. Suppose that over the period of 1 year, Company A has produced and sold a certain total value of products. Now, Company A has sold its products to either households, which we'll call consumption, or to other companies, which we'll call intermediate sales. A household usually consists of a family with parents and a few kids, but it might just as well be someone who's single, but always real physical people. A household is considered as just another economic agent, like a company. Now, to produce all these products, Company A first had to purchase certain products from other companies. If Company A produces, for instance, smartphones, it probably doesn't manufacture the microprocessors or the memory banks that go into those smartphones. So it needs to purchase them from specialized manufacturers. Another example, when the company drafts the manual for a new smartphone model, it hires a legal firm to work out the disclaimer texts. We call these purchases of products with other companies intermediate purchases. Interests paid by the company on a bank loan or rent paid to the corporate owner of the company's office building are also intermediate purchases. We use the term intermediate because the purchases of these products happen as part of the production process of final products. GDP only registers final products. We'll go into that later. Now, to produce all these products, the company needs to pay income to households. The company pays this income mostly by way of wages, like the wages of factory workers, technicians, accountants, secretaries, delivery truck drivers, etc. These are people that are actually employed by the company. But it also pays income to households that are shareholders to the company. That income is paid in the form of dividends. Households that own some sort of debt title, like a corporate bond, are paid in the form of interests. Households that hold commercial or industrial real estate can charge rent to the company. And when they hold intellectual property, the company pays them a license fee. The last two forms of income are rather exceptional, as the assets that generate the revenue are usually indirectly held by those households through special purpose companies. Mind you, both sides of the diagram are exactly the same size. And the idea is that it stays that way. What we add or subtract from one side, we have to add or subtract from the other side. That's the principle of double entry accounting, which goes back all the way to medieval Italy, to the lovely city of Genoa. The two sides tell different stories too. The right-hand side gives a breakdown of what is required to produce the company's products during the period we're considering. The left-hand side shows where those products ended up within that same period. Time to add some more realism. Imagine Company A purchased products abroad. Economists call those purchases imports. Imports are really a form of intermediate purchases, so we'll put them on the right-hand side. By the same token, if company A sells products abroad, those sales are called exports. They're really a form of intermediate sales, so they'll go on the left-hand side. We can add some more reality still. What if the company didn't manage to sell some of the goods it produced? It's made intermediate purchases and paid income to do so, but now there's nothing to show for it on the left side of our diagram. To that purpose, we need a new category, which we'll call inventory. Goods that are being stocked. So when the company doesn't sell the goods it produced, its inventory increases. This increase is calculated at cost price, because there's no sales tax or company profit added to the value of the goods, because they haven't been sold. Likewise, it's also possible that company A has decided to build a new storage facility for its own use. It does the constructing itself. Again, it'll have made intermediate purchases and paid income to construct that facility, but it didn't sell that facility. So yet again, we have to create a new post. It's called investment. Investments are crucial for companies. They are not only buildings, but also machinery, information networks, vehicles, what have you. These are all key in maintaining innovation and competitiveness. Now, these investments gradually lose their value over time. That loss is a kind of invisible production cost, for which a provision needs to be set aside. So it too gets its own post, called depreciation. Likewise for company earnings that were not distributed to shareholders. Like depreciation, they get their dedicated post as undistributed profits. These posts, depreciation and undistributed profits, actually represent a kind of savings account, a piggy bank for the company, but also a leakage to income. Whatever is on these posts cannot be paid out to households. This sounds too good. Where's the government? Well, the government also buys stuff, like pencils, electricity, fighter jets, legal advice. But expenditures by the government don't classify as consumption or intermediate sales, so they get their own dedicated post. Great, a government without any taxes. You wish. Company A does have to pay taxes. Taxes are just another part of the cost of products sold, so they go on the right-hand side. These taxes can be indirect, like sales taxes, which are part of the sales price, or direct, like corporate and social security taxes. They all flow to the government, leaking away from income. Mind you, the column sizes continue to be equal. So far, so good. Now let's focus on those intermediate transactions. If company A is the only thing happening in the economy, we already have a pretty good view on what's going on. But of course, it's not. Remember that company A purchases from other companies and sells to other companies. That means our little universe of only one company is a bit too small. Let's extend it with two companies. It's still a far cry from reality, but to explain the principle, we really don't need any more companies. Let's say company A sells all its products to company C. So company A's intermediate sales are made entirely to company C. And to produce those products, company A needed to purchase products from company B. So those are intermediate purchases with company B. Let's have a closer look at the accounts of company B. Company B is a different company than company A, so it's only normal that the post sizes differ. However, there are two posts that are exactly the same size. The intermediate sales of company B to company A are per definition equal to the intermediate purchases of company A with company B. Company B also traded with company C. So let's head over to company C. Again, the intermediate purchases of company C with company B are equal to the intermediate sales of company B to company C. There are also the purchases of company C made with company A. And finally, there are the sales to company B. So they're all trading happily among them. Now, let's stack the accounts of the three companies on top of each other. What we get is a sort of aggregate accounts for the entire economy. Because in all the three company accounts, the left side is equal in size to the right-hand side, that's also true for the combined stack. The left stack is equal in size to the right stack. And this is where the magic happens. What company A sold to company C is in the left stack, and what company C purchased from company A is in the right stack. Because these rectangles are equal in size, we can bar them against each other, while keeping the totals of both stacks equal. We can do the same for the sales of company B to company A, and for the sales of company C to company B, and finally for the sales of company B to company C. If we now compress what's left into a single pair of stacks, we get a picture of the whole economy, without any intermediate transactions. The size of the left stack remains identical to the size of the right stack. We only need to rearrange things a bit. You can see that the intermediate transactions have all disappeared. Now, you may be wondering why on earth do we have to bar those intermediate transactions? Why not just leave them there? Well, we have to bar them. Otherwise, we would be doing double counting. That's because the value of an intermediate product, in this case the product purchased by company A from company B, consists itself for a great deal of the income, meaning wages, dividends and interests, the selling company, company B, paid to produce that product. When the selling company is added to our stack, that income is already contained in that company's right column. So when the accounts of the purchasing company, company A, are added, that income is yet again added to the right stack, which would be double counting. Another way of putting it is that we're only interested in the value companies add to their intermediate purchases, not in the value of those intermediate purchases themselves. What it actually means is that the sale of a product in itself doesn't add any value to the economy, apart from the profit that was made on the sale, which is a kind of income to the seller. Now that makes sense. Otherwise, two companies could buy themselves at $1 million per day to the economy, just by selling and reselling between them a trainload of iron ore. All they need to do is sign up on the contract each day. Okay, so now we have a total picture of our economy, with everything squaring off just fine. There's still a few changes we need to make. Changes we couldn't do when we were still at company level. First, the government also pays wages, directly to households, like to civil servants, temporary employees, and yes, politicians. Those are added to income. And the government doesn't only tax corporations, but also households, by means of income taxes. There are also two special kinds of government expenditures. The first one are the interest payments the government makes on its debt. The second are the payments the government makes to companies and households without expecting anything in return, like subsidies and unemployment benefits. We call these transfers. Now we've finally covered everything there is to cover in our economy. But does that mean that the size of the stacks represents GDP? Not quite. Interests and transfers actually are not supposed to add economic value. Pensions, for instance, is money that's already been earned in previous periods. But pensions do add to income. We solve this little conundrum by deleting interests and transfers from the left stack and subtracting them from total taxes in the right stack. So taxes have now become net taxes, meaning the net revenue the government receives from companies and households. We can follow the same line of thought for exports and imports. Exports add value to the economy. After all, to produce the exported products, income was generated. That is, for the part that didn't use any imports. So if we subtract imports from exports, we can put the result on the left side of our stack. as net exports. Exports only add value to the economy for the part that exceeds imports. And yes, we finally come to our goal of determining GDP. Because the size of each stack is nothing other than GDP. Actually, each of the two stacks explains GDP in a different manner. The left-hand side is called the Expenditures Approach, and the right-hand side is called the Income Approach. They're two sides of the same coin. Again, notice that the intermediate transactions have completely disappeared. The stacks contain only the value of final products. Final products are products that have reached a final destination. That means that at no point later in the considered period they have been used in a production process. That final destination can be either exports, investments, government expenditures, or consumption. The word gross in gross domestic product means that we haven't deducted the depreciation of the nation's production assets, like factories, machinery, offices, warehouses, etc. Well, this is all very well, but what can we do with it in economic policy? Well, let's have a look at one thing we can do with it. You may have noticed that we used only 4 colors in our diagram. Well, they indicate the 4 main aggregates in the economy. Now we'll give them, or their components, distinctive letter markers. X stands for net exports. This is the trade balance aggregate. I stands for both investments and inventory buildup. This is the investment aggregate. G stands for government expenditures. By the way, expenditures for constructing things like roads, schools and bridges are also investments, but they are part of G. I is reserved for investments by companies and households. T stands for the net tax revenue the government receives from households and companies. So things like subsidies and pensions that go out to households and companies have first been subtracted. Together with government expenditures, they form the government aggregate. C is the value of the products sold to households, like a haircut, a pizza, a PC or a car. There is one exception. When a household constructs a house, the expenditures that it makes to that purpose are registered under investments, as a so-called residential investment. QD stands for disposable income available to households. They can either consume or save this money. SB stands for business savings. We mentioned earlier that depreciation provisions and undistributed profits are a company's way of saving. That money is not available to households. Consumption, income and business savings together form the savings aggregate. We can put these symbols into a single equation, which you might call the base equation of macroeconomics. You could say that this equation is to economists what E is equal to mc squared is to physicists. The equation is also an identity, which means that the equal sign is always valid. We saw earlier that the two sides of the equation are equal to GDP. The equation is usually rearranged by grouping the 4 aggregates, like so. Careful, now the two sides of the equation are no longer equal to GDP. Now it becomes clear why income and consumption ended up in the savings aggregate. If you deduct consumption from income, you get what households saved during the period, the so-called personal savings. Business savings and personal savings together constitute the entire savings of the economy. Now, almost anywhere in the world, governments run a budget deficit. That means that T minus G is negative. That means that savings should be able to finance both investments and the budget deficit. If an economy saves really well, then there is unconsumed production that can go into exports. So savings finance exports as well. Let's see what this looks like in our fictional economy. Savings were enough to cover both investments and the budget deficit. There was even some money left to finance exports. What if we apply this equation to a real economy, like that of the United States? In 2018, the US posted a GDP of $20.5 trillion. Out of those, Americans managed to save about $3.5 trillion. But at the same time, they invested in factories, machines, warehouses, houses, etc. for slightly more than $3.6 trillion. So already there was a problem, with savings being too low to cover investments. But on top of that, those savings somehow also had to take care of a humongous budget deficit of almost $800 billion. But how does the US get away with this huge budget deficit? Well, remember that the base equation is always valid. So mathematically, the only solution was that net exports were negative, meaning more imports than exports. In other words, a trade deficit. And that's indeed what happened. The full US government deficit and the last $100 billion of investments were financed with a trade deficit of almost $900 billion. But how on earth can imports finance a budget? Or for that matter, investments? Well, if you're on a trade deficit, that basically means that the rest of the world sold more to you than you sold to the rest of the world. So the rest of the world has received more dollars than it has paid. So the dollar holdings of the rest of the world have increased. Those excess dollars end up in bank accounts. But the rest of the world wants to do something with those dollars. Since there are no more US exports left to buy, it needs to buy investment instruments that are denominated in US dollars, like shares in US companies, US corporate bonds, and first and foremost, US government bonds. Now, couldn't the world get rid of its dollars just by selling them in the market? Well, it could, but that would send the dollar plunging. And with it the value it worked so hard for. So the world prefers to buy US bonds and US shares with its dollars instead. But that doesn't mean the US doesn't have a problem. Because what it's basically doing is selling the country to foreign investors at the tune of $900 billion per year. Inevitably, at a certain point, these investors will start requesting corporate board representation and eventually corporate board control. Now, if you keep in mind that the people who run your companies in the end run your country, there might be a political issue here. Then how do other countries solve this problem? Well, you solve the problem by avoiding it. And you avoid the problem by consuming less and saving more. Let's have a look at the European Union. European GDP is a fifth lower than that of the United States, but nevertheless, European savings are about as high as US savings. High enough to finance all investments and then some. On top of that, the combined EU budget deficit is only 1/10 the size of the US budget deficit. This means that you only need a small trade deficit to pay for the remaining investment needs. And if you thought that Europeans are excessive savers, then let's have a look at the Chinese. The Chinese economy in 2018 was even smaller than Europe's, but still it saved some $2 trillion more, sufficient to finance its huge investments and its relatively large budget deficit, and at the same time get richer with a trade balance surplus. So making these interesting comparisons is just one of the things you can do with GDP accounts. Hopefully this was useful, and catch you in the next episode of Member of the Public. Bye bye.